Thank you. Thank you very much, Chris. And thank you, everyone, for having me today. My name is 𝗪𝘆𝘀𝗲. I'm a global market strategist at JPMorgan Asset Management. Thank you for sticking around with me all the way till this Saturday afternoon and this very bustling event. I hope everyone has been enjoying themselves. So, if you may not be very familiar with us, JPMorgan Asset Management is one of the largest asset managers in the world. Now, you may know us as a bank on Wall Street, but what you may not know is that we have had our footprint in Asia for over 50 years. Now, what JPMorgan can offer you is best-in-class solutions and strategies, as well as investing knowledge. Now, I have my colleagues right at the booth behind you right there, and they'll be more than happy to assist you with our best-in-class strategies and solutions. But what I can do right now over the course of the next 20 minutes is to share what we are thinking about our investing outlook of 2024. Now, we know that investing is a very deeply, very personal sort of decisions that you can make, and we can relate to it. It can be very daunting. There's a whole host of asset classes that you can invest in. And hopefully, it may not be as daunting as this chart that you can see right in front of you. Now, what this chart really represents is a select 10 asset classes, potentially that you can invest in. Now, one color represents one asset class. And what it's trying to tell you is actually being ranked from an asset class that performance is right at the top to the lowest performance of returns for that particular asset class. So this rank from top to bottom for the last 10, 11 years. Now, what you notice is that all the colors all jumbled up, right? And this really tells you that there's not one consistent strategy, i.e. there's not one color that consistently dominates any sort of investment strategy. Now, we think that this is very important to note because it means that if you were to invest, you need an investment strategy that, number one, gives you the discipline, and number two, gives you the comfort to hold on to the investment decisions that you made on day one. And for that, maybe I'll just show a couple of, pointing out one asset class that stands out in our minds, and that is DM equities in green, which is really developed market equities, right? And if you look at the returns in circle right there, in the annualized return basis, it's returned more than 9%, and that beats the second best performing asset class over a decade of that returns by a mile. Now, if you look at how it has performed, and that you follow that wavy line across the chart over there, you notice there are only 2 years that developed market equities did not do well. And that really is 2018 and 2022. And those 2 years is when really asset classes across the board did not perform. So really, if you exclude those 2 episodes, you think that developed markets is doing relatively okay. And we'll talk about that a little bit later. I did mention very briefly, 2022 was a very painful year if you're an investor. And it probably left a scar in your psyche if you're investing, not only for investors, but also for economists. Now, let's set the stage and we'll see where we were at in January 2023. We were also concerned. The hard landing was the buzzword that everyone was thinking about. Everyone was saying, oh, you know, the economies are going to go into recession because the central banks are going to send us there through over-tightening, right? If you're a business owner, you probably were feeling, oh, it's very uncertain. I may not want to invest because it's going to cost me a lot of money to actually take out a loan. If you're a homeowner, which I'm sure many of us in this room are, and you get that dreaded refinancing letter that comes, you'll probably be wondering, oh no, what do I do? Do I take a fixed rate or should I take a chance? Because I don't know what the interest rate is going to be in the next 2 years. I know because I had the very same painful conversation in my household in November 2022. Now, lo and behold, by the end of 2023, you saw S&P returns up 24%. Your top 10 stocks perform 62% price returns. Not too shabby, right? And this was just last month. So now we're going from a pessimistic year, and we ended the year with a lot of optimism. And this optimism continued into 2024, because now the buzzword is no longer hard landing, it's soft landing. Now we think that, look, the central banks are doing okay, they're not sending us into a recession. Now, we all don't know what the 2024 numbers of the past actually will look like, because none of us will be in this room right now if we knew that. And also, hopefully, we get that opportunity to actually revisit these numbers by the end of the year. But what we know is that there is a lot of emotions that are involved in investing. And what we do advise investors is that try to remove the emotions when it comes to investing personally through leaning on investment professionals. And to that, in that spirit of investment professionals, I do implore you, if you do have the time, do go across just right behind you in the crowd. We do have our booth right there where our friendly colleagues will assist you to share with you our best-in-class solutions. Now, let's talk about 2024. We said soft landing. That doesn't come without any risk. Imagine right now if I were to be going to East Coast right now, whether I want to do a parasailing or if I want to just take a stroll at East Coast right now. What I would do is I would take out my phone, check the NEA app for the weather. I need to check where the winds are, whether there's going to rain or not. And really, that sort of principle can be applied to investing as well. You need to be very aware of all the risk that could come with investing. And 2024 is a year that there are risks, so please do not be mistaken. Now, these are just a few of the risks, and I'll just highlight two over here. The top right corner, impact from election outcomes. We have a very, very busy election calendar in emerging economies as well as developed economies. We have Taiwan, we have India, we have South Korea, and obviously the grand event of the year, the US presidential elections in November of this year. Now, what the particular risk I want to bring your attention to, though, is the one at the bottom, restrictive monetary policy, which was really the risk that all of us were worried about at the start of 2023. But lo and behold, the central bank in the US delivered us an early Christmas present last month. They're saying, look, we're now prepared to cut. So you see that trend line going down. And they're not cutting because they're scared that the economy is going to go into recession. That's a bad sort of cut. This cut is good because now they're saying we need to normalize interest rate. But we're not saying that there's going to be a recession. So that is good for investors. So meaning, if you're a business owner and you had that sort of, if you were still on the fence, should I invest more, you'd probably be less afraid. And on a personal note, when I get my refinancing letter this November, after 2 years, I'll probably be very less scared. I wouldn't be having that sort of conversation and be on the phone and calling, what's the best rate or not. I'll probably be a lot less stressed. So that's a good thing all around. Now, before we talk about the opportunities that what the Fed has given us, let's talk a little bit about cash. Because I think we all can agree, in 2023 at the start, if I were to take a poll in this whole room right now and ask, how many of you were actually shopping for fixed deposit rates? How many of you were Googling what's the best fixed deposit rate, served by different banks? At about north of 4% in January 2023, I would agree that was very, very attractive. Now you notice that the conversations around fixed deposit has kind of died down a little bit. And it's not really a coincidence because this really kind of happened in conjunction with the fact that the Fed has stopped hiking. This means that if we are right, and we got the soft landing scenario, which is the scenario in green, and cash rates go down, it means that you might want to look somewhere further away from cash as well, and perhaps look at stocks. Now, let's bring back the chart that we really like. Let's look at cash, and cash would be the one in blue. It performed relatively okay, annualized return, but look, the only 2 years that it outperformed was that very 2 years where there was broad market downturn. Now again, we're saying that there's not going to be a recession in 2024. So I think we can kind of figure out that cash may not be, if you drag this out to 2024, cash may not be on top of that table going forward. And maybe let's even take this one step further. Let's stress test this. If you were an investor and you had $100 in 1992, you invested it in cash, your returns by the end of 2023 would return you less than 100. Now, if you had taken the $100 and you went into US equities, just look at where the gray line is right now. That would have been your return. So again, as investors, we have different investment horizon profiles, right? Some of us are short-term investors, and in that sort of environment, maybe cash is still good. And if, in that sort of environment, you might want to lean into iFAST good hands in your auto sweep account, for example. But if you're an investor and you had a longer-term horizon, you're thinking, look, I want X amount by the time I retire for my kids, etc., you might want to look away from cash as well. Which brings me to developed market equities. We kind of set the stage, right? Developed market equities performed relatively well in the last couple of years. Now, you know, I think a lot of you have probably heard a lot about the Magnificent Seven today. And I won't bore you with more information about Magnificent Seven. But you know, obviously NVIDIA is one of those Magnificent Seven stocks. And the nature of these stocks is that stocks like NVIDIA, they tend to grow at a faster pace than a normal company. But the earnings that they return, you're not going to see it immediately. You're going to see it only in the distant future. Which means that, remember up front, I said, look, the top 10 stocks had delivered more than 60% price return at the start of the year. The earnings of those top 10 companies have not kept up. Which means that there is a mismatch between the price and the earnings that you might get if you own that stocks. Which means that the markets right now are overlooking some companies that could offer good, high-quality returns. And this is why we think that, you know, at JP Morgan, we should focus on quality. Now, here at JP Morgan, we don't just look at simple metrics such as the return of equities, right? We engage with companies, we speak to them, we make sure that the earnings that they would deliver would be sustainable, that would be consistent, that would get you through very turbulent times. Again, it's about having that market comfort for you to hold on to your investment decisions that you made on day zero, right? And also, so what we're saying here, the key message is that look for companies that are being overlooked right now, companies that have good balance sheet right now and consistent earnings. And now, if you notice the title of our whole deck today, Substance over Style, I think the message over here is that some of us obviously had a very good year if you had exposure to growth stocks, whether is it through a single name stock or you had exposure through growth fund. It was a very good 2023 for you. But the whole message of what this chart is conveying is that there is no one style that will get you through all business cycles. And if you can look at the chart on the left, there are some periods of time where growth performs better than value, and for other times, value performs better than growth. So having that sort of adaptability is very important. So here at JP Morgan Asset Management, we do ask investors to also think about having a diversified core portfolio. Now, we heard a lot about US equities, right? And we heard a lot about AI. Now, what is important to understand about artificial intelligence is that it is not US-centric, right? What you see right now in AI, if you fast forward 5 years, the way that we're going to do our work in the office, the way that we consume technology is going to change because of AI. That's how pervasive AI is going to be. So this is really a global secular trend and not a US-centric trend. And in that context, you might actually want to look beyond US equities and into international equities. And this is the reason why. If you look at this chart, this really is the ratio of valuations of global stocks versus US stocks, right? And what you're seeing right now is that global equities, international equities are trading at the deepest discount to the US equities, meaning that international equities are about 30% cheaper than US equities. So again, the message over here is that if you really want exposure to global secular trends such as AI, which you know we can't run away, we either ride it or we get left behind, then you might want to look beyond the US, especially if you're a long-term investor. So again, 3 key points, right? The valuation, the entry points are good right now. The fundamentals of the macro backdrop is not too bad. And also, finally, the US dollar is going to weaken over the course of 2024, and that typically bodes very well for international equities. Now, if you indulge me in one final point I'll make in this presentation before I wrap it up, it's the importance of staying focused and staying invested. Now, this chart really shows you that some investors really have very varying time horizons when it comes to investment, whether it's 1 year, 5 years, 15 years, 10 years, 20 years, right? And if you look at if you had a 1-year horizon investment window, what you notice is that the returns, whether you invest solely in bonds, you invest solely in equities, or you even do a blended portfolio, the returns that you're going to get is really going to be very volatile. But if you stay for a longer time, 5, 10, 15 years, you see that the returns that you're going to get are a lot more stable. So again, this goes back to my very top point, which is the importance of having an investment strategy. Gives you, number one, discipline and comfort to stay put with your decisions. Now, with that, just to summarize the key points that we went through over the last 19 minutes or so, number one is that 2024, soft landing year, but not a year without risk, so please be mindful. Number two, cash is unlikely to be king, and if you're a long-term investor, you might want to look beyond cash. Number three, please stay focused on quality in stocks, especially given those risks that we had highlighted earlier. And again, there is a lot of benefits of staying focused and staying invested. And so with that, I'm going to conclude my presentation right now. Thank you so much for the time that you've been allowing me to speak. And on behalf of 𝗪𝘃 Asset Management, thank you again for the time. And please do find some time to visit our booth right behind you. Thank you again and have a lovely evening ahead.